An expert tracker in the wilderness can, from a single broken twig or a faint impression in the earth, tell a complete story of the animal that passed. He knows its species, its direction, and its intent. The market, much like the wild, leaves its own trail. Most traders wait for the beast to emerge into the clearing, for the obvious, powerful breakout that is plain for all to see. But Richard Wyckoff was a tracker. He was a student of the market's subtle footprints, the faint traces of intention left behind by the great financial interests long before the stampede began. He did not seek tips or rumors. He sought evidence, or proof. Today we will learn to read these signs. We will study 7 of these subtle yet critically important signals that serve as proof of the market's true intent and which foretell a great move with astonishing clarity. Before we continue, please subscribe and leave a quick comment. Even 1 word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. The first and most fundamental signal in this lexicon of evidence is what is properly termed the stopping action. It is a foundational truth of market movements that a major trend, which may have persisted for months or even years, does not simply vanish. Its termination is a process, a campaign of immense scale conducted by the most astute financial minds. This process begins the moment the overwhelming force of the prevailing trend is met by an opposing force of equal or greater magnitude. The very first piece of evidence that such a battle has commenced appears in the form of this stopping action. Let us first consider a market in the throes of a prolonged and demoralizing decline. Public sentiment is at its nadir. Those who bought higher up have either been forced to sell or are clinging to their positions with dwindling hope. The news flow is uniformly negative. It is in this environment of despair that the first stage of the stopping action appears, the preliminary support. After a long slide, a day or a week of trading will suddenly exhibit a marked change in character. The price range for the session will widen considerably, and the volume of transactions will show a distinct increase. Although the price continues to make new lows, this sudden injection of activity is the first tangible proof that a new and powerful interest has entered the market on the buy side. This is the composite operator's initial probe. He is not attempting to single-handedly reverse the entire trend at this point. Rather, he is making a calculated stand to gauge the intensity of the remaining selling pressure. He provides a substantial pool of demand to see how much supply it absorbs. This act of preliminary support is his first reconnaissance mission, the first shot fired in what will become a long campaign of accumulation. It is the market's first whisper that the seemingly unopposed decline has finally met a worthy adversary. This initial gesture, however, is merely the prelude to the main event, the most dramatic and telling phase of the stopping action, the selling climax. The selling climax is the point of maximum emotional intensity, the very nadir of public despair. The steady decline that preceded it often accelerates into a near vertical waterfall as the last remaining holders, their financial and psychological endurance utterly broken, finally capitulate. They throw their shares onto the market without regard for price, their only motivation being to escape the pain. This is panic in its purest form. On the chart, this event is unmistakable. It is a day or a week of extraordinary price action, characterized by an exceptionally wide spread to the downside on climactic, often the highest, volume seen in the entire decline. The amateur observer looking at this terrifying plunge sees only the confirmation of his worst fears. He sees a stock in freefall, a company in ruin, and believes the final crash is at hand. But the trained Wyckoffian analyst, the market tracker, sees something entirely different. He looks past the violent price drop and focuses on 2 critical pieces of evidence. First, the monumental volume. He asks, if everyone is selling in a panic, who is on the other side of those transactions, buying every share that is offered? Second, and most importantly, he scrutinizes the close of the price bar. More often than not, a true selling climax bar will close significantly up from its absolute low. The price may have plunged to $100 during the session, but it closes at 105 or 110. This is the definitive proof. The enormous climactic wave of supply from the panicked public was met, absorbed, and ultimately overwhelmed by an even greater invisible wave of demand from the composite operator. He used the public's panic as the perfect opportunity to acquire a substantial portion of his intended position at the most advantageous prices. The selling climax, therefore, is not an ending, but a beginning. It is the proof of a massive climactic transfer of ownership from weak, fearful, and uninformed hands into the strong, patient, and intelligent hands of the professional interests who will orchestrate the next major advance. This entire process of stopping action unfolds in a mirror image at a market top during the phase of distribution. As an uptrend matures and public enthusiasm reaches a fever pitch, the composite operator begins his campaign to unload the very shares he accumulated at the lows. The first evidence of this is the preliminary supply. Amidst the widespread optimism, a rally will suddenly be met with a notable increase in volume and a widening of the price spread, yet it will fail to make significant upward progress, often stalling and closing below its peak. This is the first proof that a large block of shares has been offered for sale, acting as a ceiling on the advance. This is the composite operator's first major act of distribution, a warning sign that the previously unimpeded demand is now meeting significant resistance. This leads eventually to the buying climax. This is the peak of public euphoria, a moment when all caution is abandoned. The news surrounding the stock is overwhelmingly positive. Analysts are upgrading their targets, and the public, convinced of unending prosperity, buys with an insatiable appetite. The chart reflects this frenzy with a dramatic surge in price on climactic, often record-setting volume. It appears to be the ultimate confirmation of the uptrend's strength. But the proof of the buying climax, just like the selling climax, lies in the subtle details. The trained eye observes that despite the incredible volume and the surge to new highs, the price fails to hold its peak. It closes the session well off its high, sometimes even in the middle or the lower part of its range. This is the irrefutable evidence. The tremendous euphoric demand from the public was used as the perfect cover for the composite operator to distribute the last and largest tranches of his holdings. He met the public's buying frenzy with an even greater supply of stock, and the failure of the price to hold its gains is the proof that supply has finally overwhelmed demand. The buying climax marks the point of maximum risk and the successful transfer of shares from strong, professional hands into weak, emotional ones, setting the stage for the subsequent decline. The second signal is more discreet, yet it provides the most conclusive proof that the dominant pressure of the prior trend has been fully neutralized. This is the signal of absorption. Following the violent crescendo of the climax event, the market enters a new phase, a period of quiet consolidation within a trading range. It is during this period that the composite operator conducts his most subtle and important work. Having absorbed the initial panic or euphoria, he must now ensure that every last bit of latent supply or demand has been exhausted before he can safely initiate a new trend. His method is to allow the market to test the boundaries established by the climax, and the evidence of his success is found in the character of these tests. The first piece of this evidence is the progressive narrowing of price spreads. As the price within the trading range drifts back towards a critical level, for instance drifting down towards the price low established during the selling climax, the professional observer pays close attention to the length of the daily or weekly price bars. If the spreads of these bars become increasingly narrow as they approach the support level, it is a powerful indication that the downward force is dissipating. The selling pressure lacks the momentum and conviction it once had. The market is becoming lethargic, a sign that the supply is being quietly absorbed on any minor weakness. This narrowing of the range demonstrates a drying up of the force that defined the preceding trend. This observation is then confirmed by the most eloquent signal on the entire chart. the evidence of diminishing volume. This is the quietest proof, and for that reason, the most profound. When a stock's price returns to test the low point of the selling climax, but the volume on that retest is a mere fraction of what it was during the climax itself, the implication is undeniable. It is the absolute proof that the supply of the stock at these prices has been exhausted. There are no more large sellers left to pressure the market. Their panic was spent during the climax, and their shares are now locked away in the vaults of the composite operator. This profound lack of selling pressure on a decline is one of the most reliable indications that a market is ready to reverse. The same logic applies at a market top. When the price rallies feebly back toward the high of the buying climax, but does so on anemic, dwindling volume, it is the definitive proof that demand is spent. The public has neither the capital nor the enthusiasm left to push prices higher. These two phenomena are perfectly synthesized in the event known as the secondary test. A secondary test is the market's deliberate journey back to the price zone of the climax to ascertain what, if any, force remains there. In a developing accumulation after the selling climax, the price will naturally drift downwards, creating fear that the decline is resuming. This is the test. If this test occurs on distinctly low volume, is characterized by narrow price spreads, and if the price holds at or ideally above the low of the selling climax, then the test is successful. It is the final conclusive proof of absorption. It confirms that the composite operator has successfully weathered the storm, has absorbed all the floating supply, and now has effective control over the stock. The pressure is gone. The path of least resistance has been subtly but surely turned from down to up. The foundation has been fully laid, and the market is now prepared for the next great move. If the first two signals which we have analyzed, the stopping action and the subsequent absorption, were the subtle but conclusive proof that a prevailing trend has met its end, then the next three signals in our study serve as the definitive proof that a new trend is being born. The painstaking and clandestine process of accumulating a large line of stock or of distributing it has reached its conclusion. The composite operator, having patiently prepared the market and secured his strategic position, must now transition from a phase of quiet maneuvering to one of decisive action. He must now commit his vast resources to initiate the directional move that he has so carefully engineered. It is at this critical juncture that he, for the first time, openly and deliberately reveals his hand. The faint, subtle footprints in the sand give way to a clear, powerful, and unmistakable stride in his intended direction. The third and fourth signals are, in essence, two sides of the same powerful coin. The first, unambiguous demonstration of directional intent. These are the sign of strength and its polar opposite, the sign of weakness. A sign of strength is the first piece of hard evidence that the balance of power within the trading range has decisively and perhaps irrevocably shifted in favor of the buyers. On the price chart, this event manifests with a distinct and often startling clarity. It appears as a day or a week of pronounced upward movement, characterized by a wide and dynamic price spread. This move will typically carry the price clear out of the upper boundary of the trading range, overcoming previous points of resistance with an authority that was previously absent. Most critically, this powerful upward thrust must be accompanied by a distinct and material increase in the volume of transactions. This signal is fundamentally different in character from the market action that preceded it. The successful secondary test which we previously discussed was proof of the absence of selling pressure. The sign of strength, by contrast, is proof of the presence of active, aggressive, and often urgent demand. It is the tangible evidence that the composite operator is no longer content to passively absorb stock as it becomes available. He is now actively and forcefully bidding for shares, driving the price upward to attract any and all remaining pockets of supply. The harmony between the wide price spread, the result, and the high volume, the effort, proves that the quality and force of the demand now vastly outweighs the quality and quantity of the available supply. The successful execution of a sign of strength is a pivotal moment. It is akin to an army breaking through an enemy's defensive line. It signals the end of a long siege and the beginning of a new offensive campaign. It is the engine of the new uptrend roaring to life for all to see. Conversely, a sign of weakness is the first clear and unambiguous proof that the forces of supply are now in complete command, and that the downward phase of the market cycle, the markdown, is imminent. It appears on the chart as a sharp and decisive decline, marked by a wide price spread that closes near its low. This move will typically violate a key support level within the trading range, such as the level established by the preliminary support, or a secondary test. Just as with its bullish counterpart, a true sign of weakness must be validated by a significant expansion in volume. This surge in volume is the critical evidence that the composite operator's intentions have fundamentally changed. He is no longer interested in supporting the price to coax the public into buying his shares. His distribution campaign is complete. His objective has now shifted to actively facilitating the decline, selling into any rallies and pressing the market downward to initiate the profitable markdown. The increased volume proves a powerful commitment to the downside, representing an urgency to liquidate that easily overwhelms any remaining pockets of latent demand. A sign of weakness is therefore the definitive evidence that the period of distribution is over. It is the market's clear declaration that the path of least resistance has turned unequivocally downward, and that the stock is now being deliberately guided lower by the most powerful forces in the market. Following this initial and often dramatic show of force, the astute professional operator will frequently conduct one final subtle test before committing the full weight of his resources to the primary trend. This brings us to the fifth, and perhaps most strategically important signal for the individual trader, the last point of support, and its bearish equivalent, the last point of supply. This signal is of paramount importance because it typically offers the most logical and lowest risk opportunity to participate in the impending move. An amateur trader, driven by emotion, will often chase the excitement of the sign of strength, buying at a high price in a moment of volatility. The seasoned professional, however, understands the market's rhythm. He knows that a powerful advance is often followed by a period of consolidation, and he patiently waits for this to occur, seeking the confirmation offered by a last point of support. A last point of support occurs after a sign of strength has clearly demonstrated the buyer's control. Following the initial powerful rally, it is natural for the market to experience a minor pullback or reaction. This pullback serves a crucial purpose. It shakes out the last of the weak holders who are inclined to sell on the first sign of strength, and it allows the composite operator to ensure the path is truly clear. This reaction should drift down to a new level of support, which is very often the top of the old trading range that was just decisively overcome by the sign of strength. The old ceiling has now become the new floor. While the location of this pullback is important, the absolute, critical, and non-negotiable proof of a valid last point of support is found in the character of the volume. This pullback must occur on substantially diminished, preferably anemic, trading volume. What does this profound lack of volume on a reaction truly prove? It is the market's final and most eloquent testimony that the aggressive buying which powered the sign of strength was successful in its mission. It proves that all significant, threatening overhead supply has been either absorbed or frightened out of the market. The low-volume pullback is the market asking one final question. Is there any more significant selling pressure left? The conspicuously light volume is the resounding and definitive answer, no. This confirmation is the final piece of the puzzle for the composite operator and for the astute trader. It proves that the path of least resistance is now virtually unobstructed to the upside. The last point of support is the final quiet breath before the markup phase begins in earnest, and it represents the professional's preferred point of entry. The last point of supply is the perfect mirror image of this process, unfolding within the context of a distribution top. After a clear sign of weakness has demonstrated the dominance of the sellers, the market will often attempt a feeble, short-lived rally. This rally is a test, a last gasp of the buying power that once defined the uptrend. this rally will typically travel back up to a new level of resistance, which is often the support level that was decisively broken during the sign of weakness. The old floor has now become the new ceiling. The proof of a valid last point of supply lies in the character of this rally. It must be anemic, uninspired, and most importantly, it must occur on conspicuously low and diminishing volume. This lack of volume is the final, damning evidence. It proves that demand is utterly exhausted. The public, who bought so eagerly at the top, has no more capital to spend. The professional interests have no desire to buy as they have already completed their selling. The market is therefore hollow, heavy, and devoid of any meaningful buying power. This feeble rally attempt fails because there is no one left to participate in it. This proof of demand exhaustion is the final confirmation for the composite operator that the markdown can now proceed without any meaningful opposition. The last point of supply demonstrates that the market is not only willing to decline, but is now fully and completely ready to do so. Wyckoff masterfully taught us to identify the sequence of market events, the sign of strength followed by the last point of support, as proof of readiness. He focused on the logical progression of supply and demand. Interestingly, his contemporary W.D. Gann approached this concept of readiness from an entirely different angle, the angle of time. Gann believed that markets matured and were ready for major moves not just based on price action, but based on hitting specific, predetermined time cycles. While Wyckoff read the tape, Gann read the calendar. To explore this fascinating and complementary approach to market timing, visit our sister channel, William Gann Trading Insights. The link in the description below. We have now examined the foundational evidence, the signals that prove an old trend has been stopped in its tracks, and the subsequent signals that confirm the intentions of the market's new leadership. These are the cornerstones of the Wyckoffian analysis. Now, however, we must delve deeper into the realm of the more subtle behavioral signals that are often imperceptible to the untrained eye. These are the advanced clues, the nuanced signs that speak volumes about the hidden dynamics of supply and demand. They are the final layers of proof that can provide the analyst with the highest degree of confidence before the primary move gets underway. This brings us to our sixth signal, a concept so fundamental that it can be considered one of Richard Wyckoff's three great laws of the market, the proof that is revealed by the relationship between effort versus result. This principle is profound in its simplicity. It states that the market, for all its complexity, cannot long conceal its true intentions when the effort expended fails to produce a commensurate result. In this context, effort is measured by the volume of transactions, and the result is measured by the price movement. When these two are in harmony, the trend is healthy. When they diverge, it is a powerful and reliable warning that a significant change is imminent. Let us consider this law in the context of a mature uptrend, at a point where public optimism is high. The stock makes a push to a new high, and in doing so generates a tremendous surge in volume. This is the effort. The uninstructed trader sees this high volume as a confirmation of strength, believing that this high level of activity must signal a powerful continuation of the trend. However, the trained Wyckoff analyst looks not only at the effort but also at the result. He observes the price bar on which this climactic volume occurred. Perhaps the bar has a very narrow spread, closing only fractionally higher than the previous bar despite the immense transactional energy. Or perhaps the bar has a wide spread, but it closes far down from its peak, leaving a long and ominous upper wick. In both cases, the result is completely out of proportion to the effort. The tremendous effort of buying, as evidenced by the huge volume, failed to produce the logical result of a strong, sustained upward price move. What does this divergence prove? It is one of the most conclusive forms of proof that a massive, hidden campaign of distribution is taking place. The high volume is indeed a sign of intense activity, but it is the activity of a great battle. The immense buying demand from an enthusiastic public is being met and absorbed by an even greater and far more intelligent supply from the composite operator. He is using the public's excitement as the perfect opportunity to unload his shares without depressing the price. The great effort fails to produce a great result because for every share that is bought, a share is being sold. This inharmonious relationship between effort and result is the very definition of supply overwhelming demand, hidden in plain sight. It is proof that the uptrend is in its terminal phase. The inverse is true in a downtrend. If a stock plunges to a new low on a surge of high volume, a great effort to the downside, but the price bar closes far up from its low, the result is inharmonious with the effort. It is proof that the immense selling pressure is being met and absorbed by a powerful hidden campaign of accumulation. Our seventh and final signal is the most forward-looking of all, though it is also the most interpretive. It is the proof offered by a change of character. Long before the definitive stopping action of a selling climax or buying climax, the market will often begin to exhibit a subtle shift in its personality, a change in its typical behavior. For the analyst who has learned to feel the rhythm of the market, this change of character is the earliest possible evidence that the underlying conditions of supply and demand are beginning to shift. It is the first faint whisper of a coming storm. One of the most common forms of a change of character is the transition from a clean, orderly trend into a sloppy, overlapping trading range. During a healthy trend, whether up or down, the price action is typically efficient. The price bars are often wide in range, trending cleanly in one direction and closing near their extremes, signifying the conviction of the dominant force. The change of character occurs when this efficient action gives way to inefficiency. The price bars become shorter. They begin to overlap one another significantly, with the high of one bar being violated by the low of the next. The closes, which once hugged the extremes of the bars, now begin to gravitate toward the middle. What does this prove? It is the visual proof that the market has transitioned from a state of imbalance, where either demand or supply was in clear control, to a new state of equilibrium. The dominant force is losing its power, and the opposing force is now strong enough to create a two-sided battle. This messy, overlapping price action is the evidence of that battle, and it is the first sign that a period of consolidation, be it for accumulation or distribution, has begun. Another form of a change of character is a sudden and dramatic increase in volatility. A stock may have been trending higher in a calm and orderly fashion for a long period. Then suddenly the market is seized by days of wild, wide-ranging price swings in both directions, often on surges of high volume. This erratic behavior is a stark departure from the previous calm. What does this abrupt change prove? It is proof that large professional interests have now entered the field in force and are actively fighting for control of the stock. This heightened volatility is the evidence of their colossal battle. The composite operator may be attempting to distribute his holdings, while other large interests may still be attempting to push the price higher. This conflict between titans of the market creates the violent swings. This change of character is a clear warning that the easy, low-risk trending environment is over, and that a period of high-risk conflict has begun, a conflict that will eventually be resolved by the establishment of a new trend. We've just outlined 7 distinct signals, 7 pieces of evidence. But knowing what they are and having the refined judgment to interpret them in the heat of the moment are two different things. How do you develop the instinct to feel a change of character or correctly judge effort versus result? This requires a deep, intuitive understanding of market philosophy, not just mechanics. This is precisely the wisdom that Richard Wyckoff codified in his masterwork, How I Trade and Invest in Stocks and Bonds. The modern adapted edition by Max Davidson serves as a bridge, translating these timeless principles into a practical mindset for today's trader. If this video gave you the clues, this book will teach you how to become the detective. The link is in the description. In conclusion, we have traced the logical sequence of evidence as it appears on the tape. We began with the initial proof that a trend is being halted, the stopping action and the subsequent absorption of pressure. We then moved to the definitive proof that a new trend is being initiated, the sign of strength or weakness, followed by the final confirmation of readiness, the last point of support or last point of supply. Finally, we examined the advanced behavioral proofs offered by the law of effort versus result and the subtle change of character. Professional trading, as taught by Richard Wyckoff, is not a mad dash to chase prices or a gamble on hopeful predictions. It is the patient, methodical work of a detective, of a prosecutor building a case. Each signal is a piece of evidence. Your task is to collect this evidence, to weigh it, and to wait until it is so overwhelming that your course of action becomes not a speculative bet, but a logical conclusion. You must act only when the proof is undeniable. This is the intellectual and philosophical shift that transforms a trader from a gambler into a market professional, and it is the only true path to longevity and success in this demanding field. For those of you who are fascinated by the lives and strategies of the true titans of Wall Street, we have a special announcement. Today, on our other channel, we are releasing an extensive feature-length documentary on the life of the legendary speculator Jesse Livermore. It covers his incredible journey from earning his first $5 to making and losing millions, his revolutionary trading rules, and the tragic lessons from his final days. A link to that channel and the Livermore video is in the description below. You won't want to miss it.